Pause whatever you're doing for a moment, because what's coming next in the precious metals space is not going to feel like a typical rally. It's going to feel abrupt, more like a heavy door slamming shut. The kind of move that makes people freeze, stare at their screens, and quietly ask themselves, did that really just happen? Before we go any further, a quick favor. I'm actively running a campaign to shut down copycat channels. If you find value in this content, please support it by subscribing and leaving a comment with John AG so the algorithm can clearly distinguish the original from the imitators. As I'm recording this, it's Friday, January 23rd, 2026, and the time is exactly 10 a.m. Drop a comment with the time you're watching this, because I'm genuinely curious to see where on the globe this message is reaching. Now here's the part that should grab your attention. This isn't just about another run in a shiny metal. What we're witnessing looks much more like a market undergoing a live repricing, as if old price tags are being ripped off and replaced in real time. Gold is hovering right near the $5,000 per ounce level, and silver is pressing up against the psychologically loaded $100 mark. That alone is enough to snap people out of autopilot. But that's not the real story. The real story is unfolding beneath the surface, inside the hidden plumbing of the financial system. That's where pressure quietly builds, unnoticed by most, until suddenly the pipe bursts. And when it does, everyone acts shocked, even though the warning signs were there minutes earlier. Today, I want to walk you through three key ideas. First, why silver's recent surge looks far less like a final top and much more like the ignition phase of a launch. Second, why the bond market is a sleeping giant that most people refuse to acknowledge. And third, the uncomfortable reality of what happens when governments try to tame that giant with freshly created money, and why precious metals tend to respond in ways that surprise even those who think they're ready. And yes, the video description includes bonus links. There's a premium WhatsApp channel for faster updates, and there's also a channel membership link. Save those, because later in this video, I'll explain exactly why getting quicker information could matter more than you think. All right, let's set the stage properly. In every major bull market, there's a moment when price stops behaving normally. It stops rising politely. It stops waiting its turn. Instead, it starts acting like it's trying to escape. If you've watched markets long enough, you recognize that moment by its fingerprint. Pullbacks become shorter, pauses get tighter, corrections that once took weeks now resolve in days. Moves that used to take days begin unfolding within hours. People often label this momentum. I prefer to call it time compression. And when time compresses, a single headline can deliver the same impact as an entire quarter of news. Silver is flashing that signature right now. But here's why that matters so much. This is exactly where the average investor gets fooled. They look at a chart and say, it already doubled, it already ran. I missed it, it's too late. That single sentence has wrecked more portfolios than bad businesses ever have. Because in these kinds of moves, the early stage feels exciting, the middle stage feels dull, and the final stage feels almost unlawful. The last phase is where candles stretch taller, headlines get louder, and people who mock the trade suddenly start explaining it to their friends as if they personally uncovered it. That's how it always goes. The real clue right now isn't just silver's price, it's how silver is behaving relative to gold. Think of gold as the elder in the room, respected, heavy, slow-moving, quiet. The asset people whisper about when they're uneasy. Silver, by contrast, is the younger sibling, more emotional, more volatile, more closely tied to factories, electricity, and real-world usage. When silver begins gaining ground against gold, it's not just a metals rally. It's a signal that the market's risk temperature is changing. And this week, that relationship has shifted in a way that's hard to ignore. With gold near $4,150 and silver hovering around 99.9, the gold-to-silver ratio sits near 50-1. That's not an arbitrary figure, it's a psychological threshold. For much of modern history, that ratio has lived well above that level. When it compresses quickly, it's telling you silver is transitioning from background character to lead role. Here's the twist. Silver doesn't need to suddenly become geologically rare for this to happen. It only needs to be perceived as scarce. And scarcity isn't just about what's in the ground. It's about logistics, refining capacity, fabrication bottlenecks, inventory levels, and whether the market can actually deliver real metal when it's demanded. Paper contracts can pretend everything is fine, right up until the moment they can't. Now let's talk about the pattern that typically precedes a true breakout, because this is where most people get shaken out. In a normal advance, price pushes higher, then drifts sideways in a messy, boring range where the chart looks like it fell asleep. People lose interest. The loudest voices declare the rally dead. Then the market springs higher again, over and over. It's like building a staircase with each step forming a new base. Silver has done this for years, and it's done it in a way that trained people not to trust it. Every time it poked higher, it got smacked back down. Every time it got exciting, it went quiet. That conditioning matters because markets love to punish the greatest number of participants. When most people expect the slapdown, the next move often comes in the opposite direction. Now add another ingredient, industrial demand, that's no longer theoretical. Here's a data point almost nobody talks about because it isn't flashy, but it's powerful. In 2024, total global silver demand was roughly 1.16 billion ounces. Industrial demand reached yet another record, driven by electronics and electrical applications. The solar industry alone consumed around 200 million ounces that year, roughly 1/5 of total demand, depending on how you calculate it. Over the last decade, solar has transformed from a minor buyer into a dominant force. And that matters because many people still think of silver only in terms of coins and bars. They imagine vaults. They don't picture solar farms, wiring, circuitry, medical devices, sensors, and countless tiny applications where silver is used and then permanently dispersed. Now I'm going to say something that might irritate some silver bulls, but it's necessary if you want to survive what's coming. Industrial demand is strong, yes, but it's not the only driver. In a true squeeze, investment demand can overwhelm the market much faster than industry ever could. That's why silver can go vertical. And it's also why silver can drop sharply in the middle of a vertical move. Which brings us to the first major cliffhanger you need to be prepared for. Even if silver is ultimately headed much higher, there can be a brutal shakeout right in the middle designed to make confident holders panic. Remember that because we're coming back to it shortly, and it may be the most important thing you hear today. Before that, let's zoom out to the macro backdrop that's turning this from a standard bull market into something more volatile and potentially far more profitable for those who stay disciplined. Look at the bond market. Most people treat bonds as boring background noise, something their uncle owns in retirement. They think yields are just technical details for economists. That mindset is a luxury, and luxuries disappear in crises. Right now, long-term government yields across major economies are elevated and unstable. In the United States, the 30-year yield has been hovering in the upper 4% range this week. In the UK, long-dated gilt yields have pushed into the low 5% zone. In Japan, officials are openly warning about rapid moves in long-term rates, while markets obsess over what the central bank might do next. Why does this matter? Because bonds are the backbone of the modern financial system. Stocks get the attention, but bonds carry the load. Governments fund themselves through bonds. Banks use them as collateral. Pension funds are built around them. When bonds wobble, the entire structure feels it. Here's the scenario nobody likes to say out loud. A genuine loss of confidence in government debt doesn't look like a typical crash. It looks like a credibility event. That's why some describe it as nuclear. Not because it explodes, but because it permanently changes the rules. Once credibility fractures, it's nearly impossible to fully restore. So what do governments do when credibility starts to crack? They don't calmly accept austerity. They don't politely default. They reach for the lever that has rescued them before, liquidity. Liquidity is a friendly word for money creation. When central banks create money to stabilize debt markets, they can calm prices temporarily. But they also broadcast a message that the currency unit is being diluted to protect the system. That message spreads fast. And that's why metals behave the way they do. Metals aren't political. They don't vote. They don't care about narratives. They respond to arithmetic. Here's another data point that adds weight. In fiscal year 2025, the U.S. government ran a deficit around $1.8 trillion. Interest costs became a massive line item, with reports suggesting interest spending exceeded $1 trillion over the year. That's not a typo. When interest reaches that scale, it becomes politically toxic and financially destabilizing. You can't reduce interest costs without lowering rates. You can't lower rates without risking inflation expectations. Put that feedback loop next to a nervous bond market and you create conditions for a sudden pivot, not a gradual shift, but a sharp one. Now let me challenge a popular narrative. Many people say this move is all about manipulation breaking or control being lost. It's a dramatic story, but it's incomplete. Yes, markets can be influenced. Yes, large players can lean on prices. But the dominant force here is structural, deficits, supply chains, industrial demand, and currency creation. Even if you removed every alleged manipulator, tangible assets would still reprice upward when paper promises are questioned. That's the uncomfortable truth. This move doesn't rely on one headline. It relies on systemic imbalance. Now let's talk about targets, the part that makes eyes widen. You've heard numbers like $200, $300, $500. I'm not here to mock them. In extreme conditions, silver can overshoot violently. History proves that. But fixating on a number while ignoring the journey is how people fail. So instead of worshiping targets, focus on drivers. If gold continues rising in a risk-off environment and the gold-to-silver ratio compresses further, silver can mathematically reach levels that feel surreal. If gold pushes towards $7,000 or $8,000 during a prolonged credibility crisis and silver reclaims a more aggressive historical relationship, then yes, silver in the hundreds becomes plausible. But you must also respect the counter-argument. Silver is an industrial metal. A deep recession could weaken manufacturing demand. Technological thrifting, using less silver per solar panel, could temporarily ease pressure. So the real question isn't, can silver hit $500? The real question is, what chain of events gets us there, and what kind of pain occurs along the way, because pain is guaranteed. Now let's revisit that mid-move trap. In past explosive runs, silver often staged a vicious reversal near the midpoint, not because the bull market ended, but because leverage got flushed out. The market shakes the tree to see who falls, then climbs again. If you're waiting for the pullback, be careful. Sometimes the pullback lasts hours. Sometimes it's a sudden 12% air pocket that recovers before you finish your coffee. And sometimes the pullback only comes after another insane surge that leaves you paralyzed. This is why discipline matters more than hype. If you already own metal, the battle is psychological. Headlines will scream top. Comment sections will predict collapse. And often the day you finally sell is the day the market explodes higher. If you don't own metal, the battle is also mental. Buying after a big move feels awful, but in a structural repricing, the early move is a warning, not the finish line. So what should you watch? Watch bonds, watch currencies, watch central bank reserve behavior, watch the gold to silver ratio like a heart monitor. Central banks continued accumulating large amounts of gold in 2025, with quarterly purchases remaining in the hundreds of tons in at least one quarter. That's not retail panic, that's institutional hedging, and institutions don't hedge for entertainment. Here's what makes this more explosive. The public is still late. Most people aren't positioned. Many aren't even paying attention. When the crowd finally wakes up, it won't be gradual. It'll be a stampede, and stampedes don't wait. Quick pause. This is where those links come in. The description includes a premium WhatsApp channel for faster alerts and a channel membership option. Members also get access to deeper, members-only research videos produced by a separate team. If you want that extra layer, it's there. Back to the story. Bond stress and metal upside aren't separate narratives. They're the same story in different languages. In bond terms, rising yields, falling prices, shaky auctions, volatile markets, and officials talking about stability. In metal terms, fading confidence, questioned currency units, and stores of value being bid like lifeboats. The deeper issue isn't a single currency move, it's trust. And trust can't be rebuilt with press conferences. When restraint disappears, everything reprices: metals, energy, land, commodities, anything that can't be printed. Energy matters here too. Energy is the tax on everything. When it rises, costs ripple through production, transport, food, and daily life. That's when inflation stops being theoretical. I'm not predicting a specific oil price. I'm telling you to watch for upside surprises. In a world where money is created to stabilize debt, commodities tend to reprice higher as purchasing power erodes. Now here's another trap: distraction. Every cycle has its shiny debate. Elections, tariffs, crises. Those are surface waves. The deeper current is debt and currency. If deficits keep growing and servicing costs keep rising, policymakers will choose inflationary paths. They'll call it stability or growth, but the result is the same. So let me ask you directly. If silver breaks above $100 and then pulls back hard, do you see that as a warning or an opportunity? Answer honestly in the comments. And tell me what you think matters more right now, the bond market or the stock market. Now, a controversial topic: alternatives. Digital assets had their moment. Some won, some lost. But in credibility crises, markets return to what has survived previous ones. History and liquidity matter. That's why gold leads. That's why silver can sprint. And this can happen faster than you expect. Confidence breaks don't unfold slowly. Timelines collapse. Here's more concrete context. Silver has run structural deficits in recent years, with estimates for 2025 around 100 million ounces. The exact number matters less than the trend. Persistent deficits drain inventories, and silver supply isn't a faucet, it's a byproduct of mining other metals. Higher prices don't instantly create more silver. Supply response takes time. Layer that with electrification and energy transition demand, and even with thrifting, total consumption can rise. Now the likely psychological timeline. Phase 1. Metals grind higher with annoying pullbacks. The public calls it a bubble. Professionals hedge quietly. Phase 2. A catalyst accelerates the move. Silver outperforms. The ratio compresses. Attention grows. Phase 3. The midpoint shakeout. Violent pullback. Panic. Weak hands exit. Phase 4. The blow-off. Unreal moves. Late crowd arrives. Phase 5. Aftermath. Policy responses determine whether prices hold or retrace. No straight lines. Straight line stories trap people. If you've had success in markets, share it below. Real stories keep others going. If silver holds above $100, the real signal will be how it behaves after. Are dips bought quickly? Does the ratio keep compressing? That's acceleration. Watch bonds for volatility, not just yield levels. Watch language about liquidity and stability. And remember, sideways boredom often precedes the next surge. A reset doesn't need an announcement. It shows up in purchasing power. When the measuring stick shrinks, prices look bigger. If bond panic hits, policy support follows. More currency chasing the same assets. That's when metals can feel like a trapdoor opening. Markets can move 5% a day, then 10%. Margin rules change. Whipsaws get violent. You survive by having a plan before it happens. Decide why you own what you own. Decide how you'll react to sudden drops. Decide your time frame. Most people don't lose because they're wrong. They lose because they had no process. Over the next few weeks, watch policy language, currency stress, reserve behavior, and the broader commodity complex. Don't let FOMO dictate rotations. Gold is steadier, silver is faster and rougher. Temperament matters. So here's the cliffhanger. Is this the start of a chain reaction or just the first tremor? The next few weeks will tell us. Check the description for those bonus links. If you're new, introduce yourself in the comments. Share your goals. And if this helped you, pass it on to someone who still thinks metals are finished. Because when paper promises wobble, assets with no counterparty risk don't need permission to move. This content is for educational purposes only. I'm not your financial advisor. Use this information to learn, then make your own decisions or consult a qualified professional.